Association. We've got a very large turnout in here. If you farm with other farm partners, find this is interesting, this will be available in an archive version on the Minnesota Corn website sometime in the next day or two. So this is a quarterly plan that we work with the corn growers on, and we certainly have some exciting markets to talk about. We are going to jump right in and begin with our usual risk disclosure statement. Corey Bratlin and I are both Series 3 commodity brokers, so we have to always do our regulatory requirement. And I'm going to go through the first and last sentence, I think, which really gives you the thrust of what you need to know. That an investment in futures contract is speculative, involves a high degree of risk, suitable only for persons who can assume the risk of loss in excess of their margin deposits. So keep that in mind if you ever open or trade in futures. Then the last sentence in the last paragraph, the opinions expressed herein are the opinions of the author only, and not the opinion of any firm the author may be affiliated or associated with. I've done a lot of work with the corn growers through the years. My family farms in Murray County, down southwest Minnesota. I graduated in the University of Minnesota, degree in Ag Econ, worked a year for the American Soybean Association. I was a guy that passed the first soybean checkoff in Minnesota. I left there, started trading in 1975, so I've been involved in the grain industry for 40 years. Current title is that I'm managing advisor and director for Kluis Commodity Advisors. Many of you may read the articles that I write in Successful Farming. Corey and I have been working together now for 12 years. Corey grew up in a family farm in South Dakota. I first met Corey. He's working in Cargill and Pipestone, wasn't it, Cargill or Corey?
Yep, Pipestone and Maloma.
Pipestone and Maloma. Family sold a lot of grain to those two facilities. So since 2008, we've been working together. Our offices might be about 4 hours apart. He's straight west of me in Willow Lake, South Dakota, but we talk many, many times a day, and it's really been a lot of fun to work closely with Corey over the last 12 years. We have a lot of information to go through today because of the volatile markets we've had. So this is our tentative agenda. Most importantly, too, type in the questions. I think the questions that you bring with you to this type of marketing webinar are just as important as Corey and I have to say. So Corey, you put a lot of these numbers together. I'll let you take over here and kind of go through all the numbers in the next few slides. So Corey?
Sure. Okay, so these are the report numbers we got here on Tuesday. The first one was the quarterly stocks report. And what I got a lot of numbers on the chart here. The first one is where were we at 1 year ago today? So where were the January 2020 numbers? And you can see here corn, 11.327 billion bushels. Okay, we like to look back at what were we at a year ago, what were we at past this past month, and then where are the trade estimates along with what the USDA numbers. We can see here, September, this under 2 billion bushels. That's again as of September 1st. That was before our crop this year. So, and that has since, worked its way down a little bit more. But so when we look at this year's numbers, these January numbers, we look at the traders looking for about 11.6 billion bushels, about a 320 or so million bushel increase in supply as of December 1st. Well, the market come in here, give us a shocker, okay? And a lot of that has to do with was this year's crop was a little bit smaller. They lowered the USDA kind of very unprecedentedly changed the yield down by 3.8 bushel an acre in this report. Typically from the November or December report and to the January report, we don't see those biggest shifts. And this time it was kind of very, very unusual, but they did lower it. And, it's after we look at the numbers, it is justifiable in that, we look at the crop condition scores going into the end of the year. So this was the shock here because, like I said, this is kind of like starting out your checkbook balance. This is the beginning balance, and instead of the market thinking we've got 11.6 billion bushels of corn, Al, you want to go back to the presentation? There we go. And instead of having 11.6 billion bushels in on our checkbook, we got 11.3. And what's also important is to note is that, hey, corn is down from where we were a year ago. Now, similar numbers, we might say, okay, why are we up this high? Well, if we go back through and could go through all these numbers and look back month by month, quarter by quarter, we started out this year with an extra 250 million bushels to begin with. So, we've consumed all that, and now we're still staring down the barrel of tighter stocks than what we were a year ago. And then, I'll talk in a few slides about the more, the current demand. So, yeah, so this was the kind of one of the big bullish surprises here, where these stocks come in here significantly less than what the trade is looking for. Okay, and again, a lot of that has to do with the yield dropping 3.8 bushel to the acre. Soybeans, okay. When we look at on the trend, 3.2 billion bushels, 2.5 billion bushels a year ago in the January report. Trade was looking for 2.9. Sure, they come in a little bit higher than what the trade is expecting. Okay, but when we look at it where we were a year ago, we are down, 300 or so, a little over 300 million bushels of stocks. So again, very significant in that, hey, this is just more of a, not that bullish of a number, but it's just a confirmation of, hey, we are consuming a lot of bushels of beans. This demand is legitimate. It's staying around, and the markets have got to work and get higher, or if not higher, get higher and stay higher to curb this demand and not just hurt it for a week or two. We're going to have to probably withstand some of these prices for a while. The wheat numbers, 1.84 billion bushel stocks a year ago. Market looking for 1.7, 1.695. Market come in at 1.67. So one thing on the wheat we like to see here, though, is we are finally getting some little bit tighter numbers here in the carryout. And I believe what that is we had a decent wheat crop this year. Demand for wheat has been very strong, and that's the one thing I will say, and we go through a couple more slides here, is the demand for corn, soybeans, and wheat is all improving and has been improving the last several years, but we're kind of seem to be clicking on all cylinders. So if you want to go to the next slide, Al. Next slide, I think we're going to talk about the yields. Yeah, the corn yields you can see here. Last year we had 167.5. Corn yield was our final yield in January. December here, just a month ago, we were talking 175.8. Many in the market, including ourselves, we were looking for a decrease. Typically, very, very typically, USDA doesn't make real big changes. We thought they've been making changes, adjusting this yield down. At one time this spring, I believe it was in our August report, USDA had this yield projected up to 181.5. So to come down that much is pretty significant. So, that was about the time when the weather started to change. We started getting from having very, very favorable conditions to getting drier and, a little warmer, but in general, we just started to dry out. So still good conditions, but you can see we go from 175.8 clear down to 172. So very significant change. That equates to like over 300 and some million bushels of production loss down. So that's where the big change was. Soybeans 47.4 a year ago. Trade was looking or upper to 50.7. The market looking for a little bit of a decline. Yeah, the USDA was kind of more in line, which is very predictable of them, coming in at 50.2. Down a half a bushel, which is still a significant change, but no major surprise there. But all in all, these are still with the acres that we planted. We had some prevent plant, not as much as a year ago, but all in all, these are still going to grow up some pretty good sized crops. So if you want to go to the next slide, Al, that's going to talk about our production numbers. This is where
Corey,
we take.
I was just
Yep.
going to mention that this was the biggest month-to-month change we've ever seen in the corn estimate from the November to the December to the final
Yep.
crop. So this is unprecedented, and that's why we had to limit up markets after the release of the report. So here are those final crop production numbers.
Yep, so now we take that yield and we multiply it by the total acres that we not planted, but what we harvested for grain. So there's always a couple numbers. We always see what we planted, and then we have the acres that we harvest for grain. There's always a percentage in there that goes to abandonment. Abandonment acres are those acres that on corn, for example, or beans, that get destroyed by weather events, crop, hail, drought, or possibly flooded out, are kind of the main ones, or like on corn situation, acres that get planted, but then they get harvested for silage, for example. So again, so usually, there's about a 91.7, 91.8% of the corn acres that we plant, we harvest for grain. About 99% of the bean acres that we plant, we harvest for grain. So we multiply those acres by this yield, we come up with our production number. You can still see it here. Trade is looking for a 14.4 billion bushel crop. They come in at 14.182. Again, that production, 300 and some million bushels less in production. Okay, you can see here we were in December at 14.5 billion bushel crop. This crop got smaller, and compare that to a year ago. Hey, we're up 500 million bushels, or 450 million bushels from a year ago. So crop. So again, it's not like we got we're short supply necessarily. We had a good crop. It's just we're just consuming that much more. Soybeans last year, down on acres quite a bit, lower yield, 3.55 billion bushel crop. We're going to get up over 4 billion, looking for 4.155 yield reduction. We come in at 4.135. So again, a little bit smaller yield. Now going forward, we probably won't see much change. Those numbers are basically locked in here now. This production number is going to be, in essence, going to be locked in. There might be some minor revisions later on, but those should be very, very minor to the extent. So these numbers should be kind of locked in here for several months, and these are what we'll kind of trade off of as far as what our demand is. So next slide, we'll talk about the carryouts. You want to go to the present? There you go, Al. Yep. Okay, so now we're looking at ending stocks. So when we talk about a marketing year, I always like to remind everybody, our marketing years on corn and beans start in September 1, and they go around till August 31st of the following year. So this year, when we're looking at ending stocks, how many bushels are we going to have left over at the end of our marketing year, at the end of August 2021? So I look at it as I start out with a year ago, we were talking just under 2 billion bushel carryout. That's kind of a common number. We like to hang around that 2 billion bushels, a little more, a little less year in and year out, but that seems to be kind of a comfort zone for the markets. December, we had this carryout down to 1.7 billion bushels, and demand just seems to be getting stronger and stronger. Trade was looking for a reduction. We got another reduction. Smaller crop, turnaround and increase in demand still very robust. And now we're talking 1.55 billion bushels. So that between the smaller crop, the smaller stocks, and a tighter carryout, that's what helped led us to this 25 cents up in the March, the May, and the July corn there on Tuesday, and get followed up with some higher move here yesterday and today again. So demand on these numbers continues to be very, very favorable. Yes, margins are starting to get very tight. We're going to talk a little bit about the ethanol, but exports, I mentioned earlier before we got started with the presentation that exports this morning were 1.4 billion bushel, or 1.4 million metric ton of corn that we sold again just this week. I think, Al, we need to sell on average about 26 or so million bushels, 25 or 26 million bushels each week. And what's interesting is last year from this week going forward, we sold on average about 30 to 31 million bushels. So if we maintain that pace, that means USDA could likely see some higher increases in export demand, thus having less carryout. So we're starting to get down here to these dangerous levels, 1.5 billion bushel carryout, when our usage is probably upwards of 14.5 to 15 billion bushels. We're knocking on that door of that scary number of 10% stocks use ratio or less. So we're definitely walking a fine line here. Soybeans. 523 million bushel carryout a year ago. Okay, that wasn't that long ago. And at one point the year before, in January of 2019, I believe we were talking excess of 900 million, almost a billion bushel carryout.
990 million bushels.
Yeah. Hard to believe, just 2 years ago.
Yep.
Anyways, but so, and then look at where we at. December, 175 million. Trade looking for with the demand we've had, China's been very, very active buying a lot of soybeans. They've cooled off some, but they've bought a lot. They did what they needed to do. Crush margins have been very good. They've gotten beat up here lately, but they seem to still be profitable. But this demand for the soy complex is very strong, and we're talking 140 million. So yeah, not as friendly numbers as what the trade was expecting, but whether we're talking 135 or 140, it really don't matter. These are very tight numbers. So the market is just, to me, it's a confirmation that this demand is legit. It's sticking around. So the prices need to work. They are doing their job. They're getting high enough to where maybe we're starting to curb that demand, and they're probably going to have to maybe stay up here for a bit anyways to make sure, to ensure we curb this demand for a bit, not just a 1 week we get a cancellation here or two of some export sales or not. But regardless, these are still very tight numbers. The tightest we got was 92 million carryout in 2012. So again, we're starting to get to some of these very dangerous levels that the market doesn't like to be around. So the wheat number, a little over 1 billion bushel carryout a year ago. We're dwindling this down, 862 million bushels down to 836 now. Definitely a step in the right direction. We are finally starting to chew into this big supply of wheat. So wheat market just has a more burdensome supply and demand type numbers. So that's what's going to maybe limit corn in essence a little bit. So I mean, we get too high price of corn, wheat will start to factor in some of the feed rations. We have seen some of the other foreign buyers come to the U.S. buy some wheat. I kind of view it as more of a value play. Hey, let's buy some wheat. We get some protein. It's cheaper than in essence buying, say, corn. Just like I say, there seems to be a food security issue right now a little bit too, where this demand on just all three commodities has been very strong, very robust, and it looks to maintain here for a little bit yet. So. Go ahead, next slide, Al. We'll talk a little bit about the South American numbers. The big point here I'd like to point out is take a look at where the January 2020 numbers were on. This is the corn production. Brazil raised about 102 million metric ton corn crop. Argentina 51. Last month 110 and 49. Okay, now where are we at this month? We saw some reductions. They have gotten a little dry, especially Argentina, especially in a little bit of Brazil, especially on this early planted corn, might be pulling back a little bit. But when I look at last year, what are you talking? 153 million metric ton corn crop. To this year, we're talking 156, 157 million metric ton corn crop. Again, they planted more acres. Yes, their crop size has gotten a little smaller, but we're still bigger than last year. Okay. And if you want to go to the next slide, we'll talk about soybeans. Again, very similar there. 126 million metric ton crop to in Brazil on the beans, to just under 49 in Argentina a year ago. Market looking for 130.8. They come in at 133. They didn't see any change, which USDA is very slow to change these yields. Not that they're always slow to react. They want to basically ensure that, hey, we do actually see a reduction that's a little more methodical, and they're changing. So we typically do see the USDA make slower changes. They don't want to get into a habit of all of a sudden you cut it 1 month and then they got to increase it the next month and get this back and forth yo-yo type action. Argentina, like we've talked about, many of us heard that they have been very warm, very dry. Crop is getting smaller. We're seeing that reflect in USDA numbers this month, going from 50 million metric ton last month down to 48. So again, overall, though, when you look at 133 and a 48, we're talking 181 million metric ton crop versus 175, 76 a year ago. All in all, still a bigger crop. They planted more acres, but when we go to the next slide, we'll look at the carryouts. Boy, we're just seem to be getting smaller and smaller and smaller carryouts. So corn, 303 million metric ton a year ago, down to 283. If you want to look back at some numbers a few years ago, it's 16, 17, these numbers on the world carryout numbers were excess of 350 million metric ton carryout. So we have been slowly, these big crop years build big demand, and then we have these fun years like we are having right now. So they make real fun bull markets in which we're in. So we're going from 350 million carryout, a million metric ton carryout just a few years ago down to 283. That's the trend that we like to watch. We're not so much hung up on the number, but is the trend getting smaller or is it getting bigger? Soybeans, 95.5 million metric ton a year ago, down to 84.3. Not to mention, just a couple years ago, we were talking this number, upwards of 120 million metric ton crop carryout. So again, the world demand seems to be coming for corn and soybeans, especially soybeans, as they keep getting smaller and smaller. Wheat, like I mentioned, we've got some more burdensome supply and demand numbers. This is just kind of wheat seems to be just be along for the ride, okay? And rightfully so. You watch wheat trade here lately, it'll get beat up for a couple days, and all of a sudden it'll come tearing right back, and then it'll get beat up for a couple days and come back. And unlike corn and beans, it just seemed like the corn and bean rallies or the breaks are very shallow and very short-lived here right now. But and this kind of tells the case. 300 million carry out a year ago, million metric ton, to 313 this month. Yeah, I mean, this is why wheat market is going to continue to struggle and be more along for the ride, I guess. So.
Okay, thanks, Corey. It's been a huge change in terms of the ending stocks and just the whole fundamental situation. Uh, April of last year, we're in the throes of the COVID scare affecting both stock and commodity prices, energy prices, and really put an important secondary low in the grain markets in the first week of August in 2020. And with the action now, we're seeing corn up 220 a bushel. So we had the limit update after the release of the crop report, 25 cents higher in March, May, and July, and now we've had a high here of 41. One of the objectives I had on the chart was up here at about 538. This is the monthly Chicago Board of Trade corn price. Every month we plot the nearby high, low, close, and so really you're seeing some additional resistance in here, probably up into this area. So this is kind of unprecedented. People and farmers are bullish enough. I'm not going to throw any more fuel on the fire, but I think it's interesting just to look at this perspective. Weekly chart again. We made the highest highs, I think, since 2014 this week. The trend has been up. But if I look at one of the momentum indicators we look at, boy, we're very overbought. And right now, a 10% correction in corn prices would be 52 cents. So keep your seatbelts on. This is going to be a volatile market. For the 21 crop, someone mentioned this earlier, it's not going up as fast. Odds are it's not going to continue on. There's a lot of resistance on my perpetual December corn chart up at 480 to 490 a bushel. And so I think that even if the nearby March, May, and July corn contracts continue to move higher, the December will participate maybe about 30% of the move, like this week. Nearby corn up about 60 cents a bushel, new crop corn up 20 cents a bushel. I look for that overall pattern to continue. But when the markets do tip over, they'll all tip over together. And so I know in 2008 and 2012, we went out and sold some crops 1 or 2 years in advance. And by 2009 and by 2013-14, putting on some very disciplined new crop hedges 1 to 2 years out. I'm not talking the entire crop, but even if you do 10 to 30% of your crop out 1 to 2 years on hedge contracts, mark them down, and odds are at harvest of 21, harvest of 22, you'll be happy. Soybeans, again, I go back to the April low, 780 on the nearby beans. The August low came in at 808. We had 2 inside months, and boy, when this thing took off and closed above $9, 1, 2, 3, 4, 5 big up months in a row. We're approaching some resistance here, up at about 15.30 a bushel. And then we have that all-time high back in August of 2012, up at 17.94. So this has been an exciting market, but again, very overbought. This is that weekly chart. We had the initial rally from the August low to the high there was about $3.22. We rallied for 78 days, corrected to 1141. If we were to get another rally like that, it projects prices up to about 1460. Also, when I look at the length of these rallies and price corrections, that third week of March really jumps out to me as an important time period to watch for potential change of trend. This is your new crop November 21 beans. We had a high here today. We spiked up let's see, 11.99. So it's one of those things, Corey, we always talk about. Don't put a hedge number at an even number. Now we'll have to see. This has been up and away, but this is going to struggle. You're going to catch a lot of increased acres for next year in soybeans, increased crop acres in South America the following year. Price works, and boy, this is going to attract a lot of acres out of spring wheat, other oilseed crops, other minor crops are going to be shifting over. The news has been bullish. We've had bullish reports, but one of the things that we've been watching is the price of ethanol. This is the monthly Chicago Board of Trade ethanol price. And you can see back in 2014, we had very high priced crude oil and gasoline, and ethanol just kind of spiked up to about $3.40 a gallon. Corn market, energy markets went lower. Corn eventually bottomed in August of 2016 at $3 a bushel. Ethanol trading at about $1.40. COVID hit. Gasoline prices went sharply lower. Crude oil prices actually went negative one day, one of the most amazing things I've seen, and ethanol prices dropped back to about 97 cents a gallon. Since then, we've seen ethanol sometimes it follows gasoline, sometimes it follows corn, but we're up to about $1.63. Even at $1.63 ethanol, after Monday, after the Tuesday limit up day, even well-managed, low-debt ethanol plants now are starting to operate in the red. So this has been a big challenge, and this is going to be an ongoing challenge. There's over 200 ethanol plants in the United States, and last report I saw, about 18 of those were shut down. This is the same, the spot ethanol. You can see back in 2009, we're up to about $1.63. I call it the COVID low at about 88 cents a gallon. And we've seen corn prices go up dramatically. Ethanol prices have been trending higher because of the number of plants that have been shut down. Just this week, ethanol sometimes will follow the corn market. Also, as we get more news of ethanol plants shutting down, that's not good news for corn prices, but the big shutdown and slowdown in other ethanol plants is positive for ethanol prices. So we've worked so hard. I grew up in Southwest Minnesota. We used to have our basis was always 60, sometimes 80 cents a bushel below the Chicago Board of Trade. 2005 through 2008, we really started seeing a lot more ethanol plants come up. All of a sudden, we've got a Illinois type basis, 20 or 30 cents under. So whether you've been an ethanol shareholder or not, these ethanol plants have had a big impact not only on futures price at the Chicago Board of Trade, but certainly has given us at the end of the Corn Belt much better basis opportunities. Ethanol drives prices and basis. Demand has improved for Minnesota corn. Ethanol production has expanded. These numbers are huge. USDA projecting 4.950 billion bushels of corn to be crushed in the ethanol, and they took that down 100 million bushels from last month. Recent estimates are that 18 of the 200 plus ethanol plants have shut down. Of the 180, some that are still running, very few are going full bore. They've got contracts to honor. They've got employees. They can't financially just quit, but they can slow down the crush. Some ethanol plants in Indiana and Ohio, where they've got a 60 or 80 cent over basis, are really slowing down their purchase of corn, and they're only taking the corn that's contracted. So the question came in earlier, Corey, about basis, and certainly we're going to need to see a lot of our corn go to the West Coast because I think the ethanol demand, the crush is beginning to slow, and that is likely to continue. Ethanol reduction can signal corn price rationing. So if you look at a 4.950 billion bushels being crushed, that's 34% of the crop. A 10% drop in ethanol crush from earlier projections takes corn usage down by 500 million bushels. 20% takes it down by a billion. So bottom line, before you get too much raging bull and talking about $7, $8, $9 corn, please realize that just a 10 or 20% drop in ethanol production can and will take corn futures sharply lower. So you need to stay with a disciplined plan for the cash corn you have left to go and looking ahead at the new crop price opportunities that you have in place, and a 10 or 20% drop. The ethanol, the Energy Information Agency report on yesterday, showed 16% less ethanol being produced than the same week last year. So we really are starting to see that develop. One thing that's been positive for ethanol plants, though, has been extremely high soybean meal prices, so the DDGs have really jumped dramatically in value. But these plants will, be survival of the fittest. The plants that have a lot of debt, plants that are not as efficient, are definitely going to slow down or just stop crushing here in the very near future. The other thing corn producers have to be aware of is hogs and pigs numbers. The December 20 hog and pig report showed all hogs down 1% from the September report, down market hogs down 1%. Very concerning, kept for breeding down 3%. And this is the first annual drop in hog numbers since 1994. The next USDA hog and pig report, March 25, 2021. So again, these are all things to be aware of, things that are unfolding, and things you need to watch. I've been through a lot of these bull runs in corn and soybeans, and when price rationing happens, a lot of times you can't really see it until after the fact. And so I'm just trying to look at some of the numbers, some of the consumption of corn, and just playing some what if games. And when you start getting corn, $5 corn, producers in the southeastern part of the U.S. feeding $5.80 or $6 a bushel corn, this gets to be a real challenge. What does this specifically mean for Minnesota? We're in for a pretty good year. We looked at our harvest. This is the change from last month. We're planting about 8 million acres of corn. We took 40,000 off from the December report to final, 40,000 acres left. We also took the yield down by about 10 bushels an acre. And we have a lot of customers that reported that their late harvested corn, especially with corn on corn, came in pretty disappointing. So you have less acres, 10 bushels less yield. Total production drops to 1.442. So I thought it was interesting, Corey, when you were talking about the production numbers out of South America. We produce in Minnesota, about 75% as much corn as the entire nation of Argentina. So that we are a major force in there. The average farm price, $4.20 a bushel. And I like to look at it, what is the total revenue for Minnesota corn farmers now? And I'm hoping you can average over $4.20 for your corn. But if we look at that, then our revenue in the state on corn farmers is the crop is worth 6 billion bushels, $6 billion, excuse me. And I look at it this way. We went from a couple of months ago losing $30 to $50 an acre to now having the opportunity to make $80 to $100 per acre. So this has been a dramatic, big change in corn outlook, and you don't have to sell it all over $5 to have a benefit from this. And so this is going to help Main Street. This is going to help a lot of ag-related businesses. And I think that 2021, we could plant 8.2 or 8.4 million acres of corn. and you now have the potential of selling that corn out off the combine for $4, or selling it out into March or July of 22 for about 420 or 430. So not only will the 2020 crop, I think, be much better price and profit than was expected, but the 2021 crop, we're not going to fix these numbers quickly. What Corey was showing, these demand-driven markets have a staying power much greater than if you get some type of weather scare type of market. Grain marketing decisions. We're going to pass it back to Corey, and we're talking about basis and what drives it and what you should look for in Minnesota. So Corey, you can
Yep.
go ahead again.
Okay. Yep. So, I get asked a lot about, what's basis. We all think we know what it is, but I just kind of want to talk a little bit about, really what drives the basis levels, and talk about a few more things here. But, there's three main things when I look at it as what drives the basis. First and foremost is the overall demand. How many outlets do we have for our corn, our soybeans, our wheat? Okay. And how good is that demand? So like right now, it's, like in Minnesota, we've had a strong ethanol market. Okay. That seems to maybe be wavering here a little bit with these higher prices, but now we're looking at export program maybe picking up and looking to kind of carry us throughout this rest of this winter into the spring and summer. So, demand is the one of the big key driver. The second part of what drives basis is overall supply. And they kind of go hand in hand, but these years where we grow a lot more corn acres, or we have that big yield where maybe we overproduce our demand, we have that extra supply, we have grain piles, there's big carries in the market. Okay, that drives the basis levels as well. That'll cause the basis to widen out. If we don't have that demand and we have a big supply, sure, we've got to stockpile this grain somewhere, and that causes basis to widen out. The last thing that drives basis levels as well is the freight. Okay. My days when I worked for Cargill, car cost, that's getting to be it's a big deal. Car costs, barge costs, fuel prices, and then overall demand for these rail cars, for example. Okay, these are all pieces that make up the cost of freight. They trade freight just like they do almost corn and soybeans on the futures, in a way that these larger companies might marry into these big shuttles, and then depending on how the supply is or the demand is, they may sell off some of those shuttle trains to some of the smaller elevators, or maybe they're short and they need to buy in these shuttle cars. Barge costs, fuel prices. What is crude oil? What's I remember back in the days when we'd get to $90, $100 plus crude oil, and pretty soon we'd get a fuel surcharge tax slapped on the rail market or on the rail cars, and that would, guess who paid for that? We did, as the farmer, because we would pay a wider basis for grain. So these are the main drivers that what drives basis. You want to flip to the next slide,
Yeah,
Al?
just a question, Corey, from one of
Yeah.
your days with Cargill, your rail car cost. What was the most extreme that you saw in terms of the cost to go to the West Coast, and what was the best that you saw? I mean, it's mind-boggling to me
It,
how much that can change.
Yeah, it is. And you get some of these years where you're short space, okay, where you have this big crop. Elevators, by chance, they have a lot of contracts on the books, but rail freight gets backed up. And I remember back when the Bakken was running at full capacity, and it was hard to get rail cars. We were competing basically with the oil fields to use the rail line going across North Dakota. I've seen them as high as paying elevators paying as high as $3,000 per car over tariff rate. So you put about 4,000 bushels in a car and you're paying $3,000 over the tariff rate. That's an extra 80, 90 cents a bushel that that elevator is eating or paying just to dump grain and keep the doors open. So that's, as I say, that's what the elevators, they kind of play this space game, and it gets to be kind of dicey in there. It's not a sport for the light of heart, that's for sure.
So if that rail car jumps by 90 cents a bushel, that means that
Yeah.
that elevator backs his bid
Yep.
up by 90 cents a bushel, right?
In
I mean,
general, yeah.
yeah, I mean, you don't have enough profit margin in an
No.
elevator to eat that 90 cents. You might take a little bit less profit on it if you can get
Mhm.
the cars in. But yeah, that was always amazing to me. And now that we've got less demand for crude out of the Bakken, at least in the short term, it's had a big difference.
Yep. So why are basis levels so good right now? I mean, in comparative, it's flat out demand. There's always, I always kind of talk, there's supply driven markets and demand driven markets. We either have too much supply or maybe too little, and where a lot of times a change of weather, either drying out or getting some beneficial rains, will kind of change that supply. But these markets like we are right now, this demand driven market, these are very unique and they don't happen all that often, and that's why they're fun. And how did we get here? First and foremost, China. I think, to me, it's low reserves. This feed demand is getting stronger. Their economy is getting better. There's this sense of need for more protein. Okay, there's this whole food security. I kind of feel that with this whole COVID-19 pandemic, a lot of countries, China, Argentina, Russia, a lot of these different countries are putting on export quotas, export tariffs, to try to keep their supply in-house per se. And I think they don't want their people to go hungry, and I think they're looking at it as, hey, we survived this one, but what happens if we go into another pandemic and we have to be shut down for longer? Okay, so I think a lot of countries are looking at their reserves, and China here, I think what happened is during the trade war, they kept dipping into those reserves, and then they had some quality issues. They had some crop problems with a lot of flooding going on. They just had a lot of things kind of all ultimately hit at once, and all of a sudden now, hey, they're trying to feed their stronger economy. They're trying to feed their growing hog numbers, their poultry numbers, and they're trying to build their reserves. And this isn't something that we see that's just going to happen 3, 6, 9 months. This may happen here for a couple years. So China is the big thing. Okay, low prices last 12 months have allowed strong crush margins. Okay, ethanol markets have been doing fairly well, even in light of the slower demand for gasoline. So yeah, they're a little negative now. Maybe if we can get back to just breaking even, it'll feel good. And then the third point there, exports, very strong. I mentioned earlier we had 1.4 combination of old crop and new crop metric ton of corn sold this week. We are on a pace right now that we sold 35 30 more than that, take that back, probably close to 40 million bushels here this week, and we only need to sell about 25 million bushels each week to achieve USDA's 2.65 billion bushel carryout. So with these exports continuing week in and week out on both corn and beans, we continue to think that possibly that USDA will probably likely increase their annual expectations for exports, thus giving us smaller carryouts. So that's what's kind of happening in the marketplace and being priced in here currently. So next slide. So China, what's going on there? Their hog herd is growing after the swine fever. They lost reports of at least 50% of their hog herd. Since then, they have been rebounding. Hard to really trust the numbers coming out there, but I've heard anywhere that they're up 30-40% from bottoming out. Okay, that just plain and simple. They need more soybeans. They need more bean meal. We looked yesterday or on Tuesday on the report, Al, before the webinar started, is corn prices in China in US terms are over $11 per bushel. Okay, soybean prices in China related back to US dollars is between $23 and $24 a bushel. Okay, on average it takes about $3.50, maybe $4 a bushel, give or take, of ocean freight to get it from the US over to them. So yeah, they can buy our stuff and lay it in cheaper than they can dip into their own reserves. So again, I like to watch those domestic prices in South America and China to kind of compare to US and see how we stack up. So the reserves rumored to be at very dangerous levels. It's something that they like to sit on a lot of reserves. And I believe with their demand, they're not canceling off much. Sure, they are canceling some here and there, but it seems like they cancel them, then they turn around and buy them for a deferred shipment. So it just, we're not seeing a big cancellations yet. So I think, I think that kind of the proof is in the pudding, in that, hey, they're legitimately needing these bushels. So, and it's going to take a couple years, I think, to build these reserves back up. And then last place, last point here, food security, food price inflation. Like I talked, $23, $24 a bushel for soybeans, US dollars in China, $11 plus for corn in China. Okay, they don't want their people to go hungry any more than what the US wants our people to go hungry. So there's this security issue, I think, of they want to have enough food to keep their people happy. You got hungry people, you're going to have unruly people. So I think that's kind of went to a little bit of light here as in the last 9 months since the COVID. So
A real historic perspective, Corey, is that when you get hungry people, you get a change in leadership.
yes, yep,
That's typically what has happened in China, and I hope that for the benefit of humanity, I hope that doesn't happen.
yep. Crush margins had been very strong. Okay, they've gotten they became softer. They maybe stabilized now after we broke out above $5. Sure, they seem to be getting weaker. Ethanol margins. When I put this together just a few days ago, it seemed to be on either side of break even. They're probably, most of them are running in the red now. But that's what's the nature of the business. The ones that are spinning off the oil, they maybe are holding a slight margin in here. But look for the grind at this as of right now to kind of sustain for the most part. But if they start running red for very long and can't project much for profits, yes, we will start to see this 10-20% reduction. And like a few slides ago Al talked, is a 10% reduction is a 500 million bushels. Pretty soon our carryout goes from 1.5 to 2 billion bushels, kind of that magic comfortable number we like to hang around. So again, I don't want to get people too bowled up in here, but I mean, the crush margins, I think, are starting to pay the price here a little bit. And the big question is how long do we stay at these margins or these price levels too, is going to be the bigger story. So next slide, Al. Exports. We're off to a huge start. A week ago on corn, we already, or excuse me, on beans, we've already got committed. What we've physically shipped, what's been spoken for, whatever you want to say, it's committed bushels, a little over 2 billion bushels of beans. USDA is still projecting about 2.2 billion bushels of exports. Okay, so yeah, we've already are already at a very strong pace. Same way with corn. 1.73 billion of the 2.65. Now, what do we need week in and week out? You can simply see, hey, we only need about 6 million bushels of beans, 25 to 26 million bushels of corn that we need to sell from this week going forward until the end of August. Okay, yeah, those seem like some big numbers. Let's put that in perspective. A year ago from this point going forward, we sold over 19 million bushels week in and week out through the end of the marketing year. Do the math, it doesn't add up. So prices are gonna have to get higher, stay higher, or we're gonna have to see bean exports are gonna have to just completely come to a screeching halt. Otherwise, if we keep on this pace, we could be out of beans way sooner than ever expected.
They're already
Soybeans.
expecting, Corey, I've heard 30, 50 million bushels of Brazilian beans making it
Yes.
into southern U.S. this summer. That's the
Yes.
only way you're going to keep the soybean meal going to the hog farms in the southeastern part of the U.S. But oh, is that expensive? You're talking about freight to get it up here, unload those ships, put it in a barge. You're talking like $2 a bushel. So if
Yep.
you have any friends in Corn Growers Association, farmers in the Delta, tell them to plant their soybeans as early as possible in a shorter season variety because the cash bids have inverted. The August bid for beans in the Delta is $2.50 to $3 a bushel higher than September. So they're going to be really scrambling to make the supply last. And price rationing can be a very painful process. And
Yeah.
unfortunately, we're not doing it very fast.
No, we're not. And and like I say, back in 2012, I think we imported around 70 to 75 million bushels of beans that year. So it's not unlikely for us to import. We import some each year. It's just this year we're going to import more than expected, just for that sheer fact. It's hard for us to ship our beans, which in general corn and beans are in the Midwest, in the Dakotas, Minnesota, Nebraska, Iowa, and get them shipped over to the southeast part of the U.S. Efficiently. So corn, like I said, we sold 35 to 40 million bushels this week. Last year we sold 30 million bushels week in and week out from here this point going forward to the end of August. Again, the math just doesn't add up. So we are probably going to continue to see demand for corn increase via exports. The question is going to be where do we see it balanced? Do we see ethanol crush come down? Do we see the feed guys, whether it's poultry, hogs, or beef, do we see that come down? So overall, I mean, this is going to be an interesting year. And like I mentioned earlier, we're seeing the strong basis levels on the ethanol plants. We are hearing a lot about, we've been talking about after the first of the year, we're going to see a strong PNW Pacific Northwest program. That is set to possibly take center stage here, so that I think we're going to see as ethanol plants maybe soften their basis, but we might start seeing some of these rail facilities, the shuttle shippers, especially in Minnesota, start to benefit from this better corn prices or export market off the PNW. So summary here, take advantage of these good basis levels. In general, if you look at your buyers, they're going to have a flat basis level, maybe inverted throughout the course of all summer. So it's if or when we start to ration, that basis will start to widen out fast. And we will start to, when that starts to widen out, it's too late. So use this inverse, get the grain moved now. If you want some reownership, definitely look at that later. But these are some good prices, good basis. Take advantage of them. Let's put some money in the bank and so on. Watch the spreads. Okay, I always watch the spreads, but I've been even more in tune with the spreads this year. And what I'm looking at is the spool spreads between corn and beans, the old crop months to the new crop months. What are they doing day in and day out, week in and week out? And if you look at those spreads, boy, they have gone, this bull spreads have really been working. Corn spread from July to December, the bean spread from July to November's, they have went from anywhere from about 15, 16 cent inverse Al to 77 cent inverse on corn. The bean inverse has went from about a 60, 70 cents to $2.18 inverse. And, until those start to soften, it still says that this market wants to probably move higher. But that's one of the indicators that we kind of like to watch, that along basis, along with overall demand, to see if this demand rationing is taking place.
Very good. Thanks, Corey. Yeah, and there's an old saying that we've talked about a lot. Bull spreads work in bull markets, and when the bull spreads stop working, it will definitely be a caution sign. Well, we wanted to go about 50 or 60 minutes. We're now 51 minutes in. Corey, do you see any more questions that we should address?
Yeah, just one thing here, just about the USDA is that far off on U.S. yield. Why would any trader believe the guesses out of the South America production when it's a hemisphere away?
Well, I don't know. The crop did get smaller. I always asked farmers if they knew what their yields were in the before they'd hit the combine, and we had all the reports of lower test weight problems starting to happen. The corn on corn yield, southern Minnesota, some spots in Iowa, coming in 20 to 50 bushels less than they expected in August, 50 to 80 bushels less than they had last year. And so the USDA, I don't always agree with them. They're not always right. They do make these periodic changes, but they still are the standard that we look at. I encourage people to reply to USDA surveys honestly as possible. The major grain companies have got their people out doing surveys trying to estimate crops in both the US and South America, but the USDA has the most resources and the best track record of anybody in the industry. So I'll continue to use USDA, realizing that they're not always right, but they are the best we have to work with. And I want to have a level playing field. If the USDA does not have access to our data and grain companies do, that's not really a level playing field to be marketing grain or trading in.
Okay, just a couple more real quick ones. Just how many bushels of corn and beans does China have in their reserves? I guess
I think
good
that's
question.
a state secret. I don't
Yeah,
think
exactly.
I don't think they know, because
Yep.
some are held by the national government, some are held by
Yep.
provincial governments. How much rice, corn, pork they have in the reserves? I would just answer it this way: it's a lot less than it was a year or two ago. And so, how much they have, and their economy is on the upswing. They seem to have gotten the COVID problem behind them a lot faster than here in the U.S. The manufacturing growing, employment starting to firm up, and so their demand food. I think, Corey, the number I saw is that their hog numbers are up about 38% from a year ago
Yeah.
and continuing to grow. Very interesting too. Just a week ago tomorrow, they started trading hog futures on the exchanges in China. And in the first 3 days, the extended hog futures, this would be for October 21, these 21, and February 22, and they dropped about 17% in the first 3 days. So they're expecting a lot more hogs and cheaper pork prices in China by a year from now.
And then this last one, and this is a good one to end with, is just, what will be the black swan event for this year? These prices are very rewarding. Hard to say, Mike. It's just be prepared, I guess, for about anything, but that's why we instill, risk management positions to take your risk off, and because, we probably will get some type of black swan event somewhere along the line, whether it's this year, next year. They're hard to guess and unforeseen. So.
And I think the other way to look at it, Corey, is that that's why they've got the options market. If you want to get some protection on new crop corn and beans here, you're not too gung-ho on putting hedges on. Just buy some at the money or slightly out of the money puts. Be willing to roll them up if this rally continues. But at this time of year, Mike, the way you protect yourself in the event of a black swan event, I think is the most efficient way to do it is in the options market. Okay, well, thank you, Corey. Thank all of you for logging in. We ended up having a very large crowd. We missed being able to go out and do the live person seminars, but we're finding that this is a very efficient way to reach out to members of the Minnesota Corn Growers Association. Their staff is great to work with. They've got great farm leadership. And again, if you like these programs, quarterly seminars, webinars with the corn growers, let the staff and the leadership know. We enjoy working with Minnesota Corn and hope to continue working with them in the future. So thanks again, Corey. Thank all of you for tuning in. Be safe, and we'll look forward to providing information to you again. I think the next one is scheduled for March of 2021. Good day.